Introduction to Covered Call ETFs. Covered Call ETFs are funds designed to generate income for shareholders by writing or selling call options against an existing equity portfolio. The word covered signifies that the underlying securities or stocks owned by the fund cover the options contracts sold. This approach can potentially offer a steady stream of distributions, often paid monthly, thereby attracting investors seeking additional income beyond standard dividends. Own the stocks. The ETF invests in an index or a basket of stocks. Sell call options. The ETF sells or writes call options on some or all of those stocks. Option premium. By writing call options, the ETF collects option premiums, which can be passed on to shareholders as part of the fund's distribution. This options-based strategy can help increase income, but also places a cap on some upside potential if the underlying stocks rally significantly above the strike price of the calls sold. Income generation and benefits. The main driver of returns for covered call ETFs is the premiums collected from selling call options. While typical equity ETFs earn income through capital appreciation and stock dividends, covered call ETFs add another income layer via option premiums. These collected premiums are often passed along to investors on a regular basis, typically monthly or quarterly, with many popular funds opting for monthly distributions to appeal to income seekers. Enhanced income. The premium boost can result in higher yield compared to a pure equity holding. Partial downside protection. The premium earned provides a cushion during minor market pullbacks, although it is generally not substantial enough to protect against severe downturns. High income potential. Covered call ETFs may offer above-average yields. Investors looking for monthly income, such as retirees, may find this especially appealing. Reduced volatility. By collecting option premiums, the fund offsets some of the losses in a down or sideways market. Though this does not eliminate risk, it can moderately dampen volatility compared to a pure equity strategy. Ease of implementation. Rather than writing calls on individual stocks themselves, investors can outsource the complexity to professional managers through a covered call ETF. This avoids the need for in-depth options knowledge and transactions in personal brokerage accounts. Limited upside. By selling call options, you forfeit gains beyond the strike price of the calls. If the market rallies strongly, covered call ETFs typically underperform the underlying index. Dividend and premium fluctuations. If market volatility declines, option premiums earned may be smaller, reducing the fund's yield. Distributions can fluctuate more than typical equity dividends. Management style. Some funds write calls at the money, whereas others may write out of the money or only on a portion of the portfolio. These nuances impact both risk and return. Understanding each fund's strategy and coverage ratio is crucial. Covered call ETFs differ primarily in the underlying index, such as the S&P 500 NASDAQ 100 or Russell 2000. Then, there's the option coverage ratio, which is the percentage of the portfolio against which the fund writes calls. This could be 100% coverage, 50% coverage, or even a dynamic approach. Another key factor is option moneyness. Some funds might write calls at the money collecting higher premiums but capping upside more aggressively, while others may choose out-of-the-money strikes, which means slightly lower premiums but greater potential for capital appreciation. All these factors, affect overall yield, total returns, volatility, and the risk profile. Now let's talk about some notable covered call ETFs, specifically QYLD and XYLD. QYLD aims to track the Cboe NASDAQ 100 Buy-Write V2 index. It invests in the NASDAQ 100 stocks and writes at-the-money call options on the index. When it comes to income, QYLD is known for high monthly distributions. However, writing calls at the money generally results in minimal upside participation if the NASDAQ rallies significantly. So while it offers an above-average yield, capital appreciation may be constrained in a strong bull market. Historically, QYLD has maintained stable distributions, making it a popular choice among income-focused investors. Strategy: Similar to QYLD except its underlying index is the S&P 500. XYLD writes at-the-money calls on the S&P 500. Income, known to distribute a slightly lower yield than QYLD on average, but it tracks the broader, more diversified S&P 500. Upside potential, again, capped by the at-the-money call strategy. Considerations can be attractive for those seeking monthly distributions but prefer an S&P 500 base. Strategy tracks the SIBO Russell 2000 Buy-Right Index, investing in smaller-cap U.S. companies. Income offers a high yield, often comparable to QYLD with monthly distributions. Risk profile. The small-cap market can be more volatile. However, the covered call premium can somewhat offset the additional volatility. Considerations. Suited to those who want covered call exposure to small-cap stocks for potential diversification and a strong yield. JEPI invests primarily in large-cap U.S. stocks and uses equity-linked notes or ELNs to generate option income. JEPI aims to deliver an attractive monthly distribution, typically lower than QYLD but with higher total returns historically. Because it actively manages the options overlay, it may allow more participation in upside while still providing considerable income. JEPI's strategy is slightly more complex than a straightforward buy-right approach, as it involves ELNs. It has gained notable popularity due to its blend of income and potential for capital appreciation. DIVO invests in dividend-paying stocks and writes covered calls on a portion of the portfolio. Distributions come from dividends plus option premiums, paid monthly. Because it writes options only on a portion of holdings, it can participate more in market rallies. DIVO often exhibits slightly lower yield than full coverage buy-right ETFs like QYLD or RYLD, but aims for higher total return potential through partial coverage and strong dividend stocks. When considering covered call ETFs, it's crucial to understand the tax implications and how they might influence your investment decisions. Let's dive into the key tax considerations and how to choose the right ETF for your portfolio. Covered call strategies involve options premiums, which can be subject to short-term capital gains rates or treated differently based on the holding period, strike price, and other factors specific to options taxation. Meanwhile, fund distributions may come as a mix of qualified dividends, non-qualified dividends, and return of capital, depending on the ETF's activity. Return of capital, or ROC, is used by some covered call ETFs. This reduces your cost basis rather than being counted as ordinary income. It can create tax efficiencies in the short term, but might result in higher capital gains down the road when you sell shares. For international investors, tax rules will vary based on your country of residence. It's essential to consult a local tax professional for specific guidance. When choosing the right covered call ETF, consider the underlying index exposure. Do you want large cap exposure like the S&P 500 or NASDAQ 100, or perhaps small cap exposure like the Russell 2000? Next, look at the coverage ratio and option strategy. Are you looking at 100% covered calls versus partial coverage? At the money versus out of the money options? These distinctions dramatically influence both income and growth potential. Then, weigh yield against total return. Higher yield funds often cap upside more aggressively. If you need the absolute highest monthly income, look to QYLD, XYLD, or RYLD. If you want a balance of growth and income, JEPI or DIVO may be more fitting. Always check liquidity and expense ratios. Look at volume and total assets under management, and consider expense ratios since those costs directly reduce returns. Finally, assess your risk tolerance and time horizon. Covered call ETFs are not immune to losses in a bear market. It's important to evaluate your comfort level with volatility and your long-term investing goals. Covered call ETFs can be an appealing solution for income-oriented investors seeking monthly distributions above typical dividend yields. By writing calls on their equity positions, these funds tap an additional source of income, option premiums, while providing some measure of downside cushion, though not full protection. QYLD, XYLD, and RYLD deliver robust yields by writing calls at the money on large and small cap indexes. JEPI attempts to balance premium income with equity market participation. DIVO focuses on dividend growth stocks, and selectively writes calls for both yield and growth potential. Be aware of the limitations of covered call strategies, namely the capped upside potential in bull markets, varying monthly distributions, and potential tax complexities. Evaluate your risk tolerance, investment objectives, and speak with a qualified financial advisor if needed before allocating capital. With prudent research and consideration, covered call ETFs can be a valuable addition to a well-diversified, income-focused portfolio.